In this video, we are going to value and analyze Nike to understand why Bill Ackman is so bullish on this company and why is he moving against the market. Investors are running away from Nike's stock, which has hit a 7-year low recently. Yet Bill Ackman is adding to this position even though it already makes up 11% of his portfolio. So what does he see in Nike that the majority of investors are missing? Today we are going to go through our 7-step analysis process to answer that question, to understand what's really happening with this sports apparel giant. Why has the stock dropped so dramatically? And is Nike's brand weakening? Or is this massive price drop actually an incredible buying opportunity? Let's start with a bit of history. If you invested $1,000 in this company 10 years ago, you bought 20 shares. And today, they would be worth something close to $1,104. And this company pays dividends, so in that time you would get $194 as dividends. So if we add together both of those numbers, we get $1,298. And that is a gain of 29.8% in 10 years. That's not impressive at all. It's significantly below what you would have earned investing in the S&P 500 during the same period. But the future doesn't have to look anything like the past, and Nike's current challenges might be creating an opportunity. Individual insiders, that is a check. 20.7% of the company is owned by individual insiders, with founder Phil Knight himself owning 17.8% of the company. And are individual insiders buying? That is an X. We don't see any transactions from insiders recently. And the super investors own this company. That is a check with 9 super investors, including Bill Ackman, for whom Nike makes up 11.3% of his portfolio, Terry Smith with 2% of his portfolio, and Robert Olstein with 0.9%. And are they buying right now? That is an X. In the last 6 months, super investors bought shares worth $694,000, but sold shares worth $17,160,000. So the majority of super investors are selling, but not Bill Ackman. He added to this position 15.3% in the last quarter. But let's look at what the fundamentals tell us about this company. Return on invested capital, that is a check at 24%. And we want to see this number higher than 10%, so that shows that the management is doing an excellent job of generating returns on invested capital. And what do we know about net profit margin? It is a check averaging 10.7% over 5 years, and the sector median is 4.6%. So Nike is more than doubling the average profitability of its peers. And now let's take a look at share buyback. It is also a check. In the last 10 years, they bought back 18.3% of shares. So long-term investors own a bigger portion of the company without investing any extra cash. And the debt, it is an X. It would take just over 2 years to pay the long-term debt with their cash flow. So Nike just missed our benchmark. But it's close enough that it's not a major concern. So Nike's financial health looks very solid. But financial health is only a part of the story. We want our companies to be strong, but also we want them to grow. Revenue growth, that is an X at 6.3% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so Nike is growing, but a bit slow. Free cash flow growth, that is a check at 12% in the last 10 years. This is excellent. It means Nike is able to consistently improve its ability to generate cash from its business. And earnings per share growth, that is an X at 9.6% in the last 10 years. Just shy of our 10% target, but still respectable. So Nike's growth story is mixed. Revenue growth has been modest, but they've done a good job turning that revenue into cash flow and earnings. Now let's see how they reward shareholders directly. The dividend yield is 2.9%, so shareholders can expect to get $1.54 annually per every share. And the payout ratio, that is an X at 50.8%. We want to see the payout ratio below 50%, so Nike is just slightly above our preference. But it's still a sustainable dividend, and there is really nothing to worry about here. As shareholders, we get half of the earnings as dividends, and the other half stays in the business and allows the company to grow. And what about dividend growth? It is a check at 10.6% 5-year growth rate. That's excellent news for income investors. Nike has consistently increased its dividend payments over time, and in 2 years, it should become a dividend aristocrat. So a company that is growing its dividend every year for at least 25 years. So we know Nike has solid financials, mixed but generally positive growth, and a very nice dividend on top. Now let's see if the current price represents a good value. Usually we use a discounted cash flow analysis to value companies, and we are of course going to do that today as well, but we will also do a bit more. Let's start today's valuation with calculating the PEGI ratio. So we will open our brand new PEGI ratio calculator, which you can get access to for free by clicking the link in the description. And for those of you who don't know, PEGI ratio stands for price to earnings growth and dividend yield ratio. It is a simplest way to determine if a company is undervalued, overvalued, or fairly priced. So let's enter the PE here. It is 18.1. Then growth rate, and let's assume a growth of 9%. So that is a bit lower than the earnings per share growth that we saw in the last decade. And finally, let's add a current dividend yield of Nike. And so the PEGI ratio is 1.5. When the ratio is below 1, that indicates that a company is undervalued. If it's over 1, it is overvalued. 1.5 may indicate that we are not that far off a fair price. Now let's take a different approach and use a comparable company analysis. So let's open our CCA calculator. And here we enter Nike, earnings per share of $3.01, current share price of 54.40, and a PE ratio of 18.1. Now let's choose 4 competitors of Nike. First, Lululemon with a PE ratio of 18.2. Then Adidas, which has a super high PE of 50.7. Puma with a PE ratio of 10.5. And finally, let's take Skechers with a PE ratio of 11.9. And that gives us an estimated intrinsic value of Nike at around $65, which is encouraging because this calculation tells us that one share of Nike is worth $65, but we can buy it for just $54. Great. But since Nike pays nice dividends and does it for over 2 decades, let's also use a dividend discount model to value it. So here is our DDM calculator. Current price is $54.40. Annual dividend is $1.54. Dividend growth rate. Well, it would be probably too optimistic to keep the 10% growth, so let's go with something a bit lower, for example, 7%. And the discount rate is going to stay at 10%. That gives us a present value of this stock at $54.93, almost exactly where it is at the moment of this recording. So when we concentrate on dividends, Nike seems fairly valued. Okay, and finally, let's use our discounted cash flow calculator. So we are going to use a 5-year average free cash flow for this calculation because it is changing quite rapidly. So that should smooth things out and hopefully give us a more realistic view of the company. So that is $4,656,000,000. Shares outstanding, that's something around 1,480,600,000. Then long-term debt, which is around $7,956,000,000. That is a big number. But the cash and cash equivalents position is even bigger, $8,601,000,000. So we get a negative net debt. They have more cash than debt. It is very good because when we are buying a business, we are also buying its bank account. We are going to leave the margin of safety, discount rate, and terminal growth rate as they are. And now we get to the fun part, our growth estimates. So in the low scenario, we will estimate a growth of 6% for the first 5 years and then 5%. That is close to the predicted growth of the industry, which is around 5.9%. In the medium scenario, we will do 8% and then 7%, and that shows a story in which Nike is going to slightly outperform its competitors. And in the high scenario, let's use 11% and then 9% growth. That is closer to the growth we saw from Nike in the last decade. So with such estimates, the intrinsic value in the low scenario is $52, in the medium scenario $60, and in the high scenario $72. And when we apply our 30% margin of safety, we get in the low scenario $36, in the medium $42, and in the high one $50. And the current price is $54. So it seems that when we use the discounted cash flow analysis, Nike is not that far off its fair value, but rather on the expensive side. What is really cool is that when we take the average from all the valuation models we use today, the intrinsic value is at $54.68, so almost exactly where the stock is today at the time of the recording. Oh, and by the way, if you want to get access to all of those calculators, then just become a Patreon. You will not only get those tools, but also access to Stock Ranking Pro to find great investment opportunities with ease, and Smart Money Portfolios to find investment ideas and follow the greatest investors in the world. The link is in the description. Nike is going through a challenging period. They've forecasted a revenue decline for 2025. The company is also facing increased competition from emerging brands affecting its market share. Direct-to-consumer sales decreased by 8% in the recent quarter. Also, it is footwear and sports apparel, and in this industry, trends can change really fast, and that is a risk, but not only for Nike, but also for all the competitors. But Nike is taking active steps to address these issues. New CEO Elliot Hill is focusing on rebuilding trust with wholesale partners after Nike failed to shift their business model towards selling directly to consumers through their own stores and online. The company also plans to cut over 1,600 jobs to save $2 billion over the next 3 years. And it plans to introduce more affordable footwear options, so they are changing. And when we open our Stock Ranking Pro and sort it by the overall score, we see that Nike is the 12th best company we ever analyzed on this channel. When we open the overview, we see just what an incredible operation it is. Strong financial health, great situation when it comes to investor sentiment, healthy and big dividends, and an acceptable growth. Nothing great, but decent. So most probably Bill Ackman is still adding to this position because he believes that even though Nike faces short-term challenges, it remains a fundamentally strong business with excellent financial health and a powerful brand. The current price may not represent a screaming bargain, but if you believe that they will accelerate growth and that they will get through all their current problems, Nike could be an interesting addition to a long-term portfolio. If you found this video interesting, you should definitely watch my analysis of Seth Klarman's massive bet on Restaurant Brands International, which is also Bill Ackman's second biggest portfolio position currently. Thanks for watching and see you in the next one.